Hi everybody, my name is Dave Wenley. This is my Calmat MBA taxation class final presentation. My topic today is tax issues for the cost of startup a business. Okay, the rule number one. Okay, under general rules for business deductions, deduction only qualified for an existing business. So if this is your new business is the same nature as your current business, no matter you at the end acquire a new business or not, your expense is qualified for deduction. For example, let's just say McDonald plans to buy KFC, so McDonald spends some money on the investigation, on the review KFC's the running status or whatever. No matter at the end McDonald purchase KFC or not, the total expense McDonald spend probably is made up subject to qualify for the deduction. So how about if the KFC want to buy T-Mobile, for example? T-Mobile and the McDonald, they are not the same nature business. So that depends on the result of the acquire or not. If the new business is not acquired at the end, your expense cannot be deducted at all. However, if a new business is acquired, there are two rules that allow you to deduct some of all of the start expense. The rule number one, the deduction of up to $5,000. However, if the total expense exceeds $50,000, allowance is reduced for each dollar exceeds $50,000. The rule number two, an amortized deduction of remaining expense. This is going to spend over the 180 months period. The 180 months is equal to 15 years. That's a long time. Okay, let's start to explain this. I'm going to show four scenarios. Okay, scenario number one. Let's still use McDonald as the example. McDonald spend $1,000 to investigate the new business, like the purchase KFC. Oh, sorry, like the T-Mobile. So the $1,000 is less than $4,000. So McDonald can deduct the total the $1,000. Scenario number two, McDonald spent like $30,000. The $30,000 is definitely more than $5,000. However, it's less than $50,000. So McDonald can deduct the $5,000 in the front, and the remaining actually is $30,000 minus the upfront $5,000, and the total divided by 180 months. So they equal to $138 per month. So this is money the McDonald can can deduct. The scenario number three, McDonald spent like the $52,000. The $52,000 is more than $50,000. However, it's less than $55,000. So McDonald can deduct $3,000. How to get the 3,000? The 3,000 actually is 50,000 minus the 50,000. 52 minus 50 in the front, and the remain is 52,000 minus the 3,000. The total divided by 180 months, the equal to $272 per month. Okay, let's see the scenario number four. Okay, scenario number four, McDonald spent much more, like the $100,000. So $100,000 is definitely more than the $55,000. So McDonald cannot deduct in the front. They can deduct $0 in front. The whole $100,000 need to be amortized by the 180 months. That's equal to $555 per month. That's for the investigation expense. So how about if with some cost is not qualified for the expense, but it can be qualified as the organization cost. For example, like the legal and accounting service fee. like you hired a lawyer company or someone to do the quiet business for you, or you got formation fee to the state of incorporation, like you form a new company that's a C corporate something or LLC something like that, or organization meeting of the director and the shareholders. For those costs are separate from your startup expense, but this follow the same rules. You can deduct tax. The same rule like the 5,000 in the front the deduction, and the total the $50,000, and overlay you need to reduce the dollar by dollar, and the same period like the 180 months the same. Hi, this is the end of my presentation. Again, my topic is tax issues for the cost of startup business. Thank you for your watching.